Hey, it's Justin. I am back. I wanted to talk to you today about the narrative that I'm hearing in 2023 about how the housing market is stabilizing and will not go into deep a deep decline. I suspect that that's not correct. Of course, nobody knows for sure, but all of the people I listen to and respect are suggesting that it will, in fact, be a decline that will go on for years. I've been saying this for months. Everything I look at suggests that. The most recent thing that supports this is a new report that investigates the 2008 downturn or housing crash, and it challenges the common notion or that it was the fault of subprime borrowers and lenders. And what is being suggested now, after crunching the data, is that it's looking more like the real cause of the all the problems that happened around 2008 was the fact that too many investors were in the market, getting now they were over leveraged, but it wasn't that they were that they couldn't qualify for a loan, or they had low credit scores. And it wasn't that these were people that shouldn't have been in the market at all. I mean, perhaps they should have been in the market, but it's not that they had these low credit scores and they were poor people. They were people who were had fairly good incomes and were just getting weight over their head in the housing market. It's as simple as that. The low income people who maybe shouldn't have been buying houses, well, or definitely shouldn't have been buying houses. Those were a factor, but they were not the main driver of the downturn. The program I want you to look at is Stoic Finance. It's one of my favorite programs, and he goes into this recent report about how once people really looked at the data, they found that for some reason it was more convenient to blame subprime borrowers and subprime lenders. However, it was the amateur investor or investors in general that brought the whole thing down. So it's something to, I think it's important to look at. The reason this is valuable information today is that is when I opened this program about the people who are suggesting that it's that since there's no subprime or there's less subprime lending, we're not going to have that kind of crash that we had some time ago. Well, the fact now what's emerging is that it wasn't the subprime. It was the investors snapping up too many houses and getting over leveraged. And the reason that's a big deal is because that's what we're seeing now. We're not seeing the subprime. We're seeing way too many investors in the market, just like we saw in 06, 07. And if you are expecting this to not be a big housing decline, a big decline in the value of housing, I think you're in for a big surprise. I think it's just going to go on for years. And it's not like it's not like I'm some genius in finance. This is what everybody's saying. Everybody that I listen to, I encourage you to check the Stoic Finance program. It'll be in the link below, and also hang in there and keep in mind that if you're looking for more affordable housing, it may still be a few years out. If you've got a property and you are interested in selling it, I have a conflict of interest because I'm a realtor. However, I don't think you're ever going to see values like we've seen a few years ago again. The reason I say that is because if housing prices decline and the dollar is inflating rapidly, can you imagine, if your house goes down, let's say 12%, and the inflation is 8%, you've lost 20% of the value of your house, not just 12%. So keep that in mind. Usually inflation is hovering around 2, 3, maybe 4%, and it's a significant amount, but it's not a financial disaster where you're getting 10 or 8, 9, 10% inflation. Really burns up your value of your property. So that's enough for me. This is Justin, the Renegade Realtor from Coast West Real Estate. Thanks for checking in. Bye.